Hi there, eToro. It is Monday and I am back. So it is time for my weekly update. Let's take a look at what moved the markets last week. First up, I am finally done with my exam. So these two textbooks, all of that knowledge is now in my brain. And that means that I have more time to spend creating content and working with the community, which is great. I really enjoy that. Okay, so this is the certification that I now hold from the Chartered Institute for Securities and Investment. It was tough, but it was a good experience, and it definitely will make me a better investor. All right, let's take a look at the market performance. So it was quite a week last week, and I'll talk through some of that in a moment. You can see the S&P 500 took quite a bit of a dip during last week. So the 12-month performance for the S&P 500 is 36-ish%, and for our portfolio is 56%. Something that has moved the markets quite a lot last week, and also again this morning, is the fact that the Delta variant of coronavirus has been spreading rapidly through the UK. So at the moment, it's obviously our lockdown has been extended. We were supposed to come out of lockdown, but that's not going to happen until July now. And that meant that UK stocks, particularly travel stocks, were quite hurt on the back of that news. In my opinion, it's the right thing to do, but it's a fine balance that needs to be struck. This morning, this guy, I assume that's Robert Buckland, made a few comments that scared the market a little bit more than it was last week, talking about how having holidays as normal were never going to be the case. So UK stocks this morning were initially very, very red, but there seems to have been a decent bounce. And if we look at the likes of EasyJet, we can see that for the past couple of weeks, there's been a fairly strong downtrend. The airlines are really having a tough time at the moment. EasyJet has done some clever things. So this is a stock that we hold. They've done some clever things, for example, increasing their domestic routes within the UK. And they're one of the healthier UK airlines. So I think they'll be fine. It's just a matter of waiting until the country is opened up again. The more material risk I see beyond things that happened last week is that this Delta variant starts spreading throughout the rest of the world and starts slowing down, opening up in places such as the US and Asia, because that would really, really throw a spanner in the works of the recovery in those areas. All right, this morning we've seen an extension of a drop in cryptocurrency prices. Ethereum is one of the, I think, is below the $2,000 mark, which is a pretty significant psychological mark. I think there are a few reasons for this. I think we're in a bear market, first of all, but also China is now looking at regulating miners within its country. So I think that this is going to continue hurting markets, crypto markets, for a while. And we might see a mass migration of a lot of mining capacity out of China to other countries, but that takes time. It'll takes time. It takes money to get it set it up and get going. So not great news for cryptos, and I will be monitoring that situation to see just how sharply cryptos might fall in the short term, because I might need to close positions, even if they are red, in anticipation of a further drop. So the big news last week was obviously the market was waiting patiently for the Fed to have their Federal Open Market Committee meeting, which was on Wednesday, and this is the meeting where they talk about monetary policy. So what we've seen in recent weeks is an obvious sharp increase in inflation, combined with a few other factors that seem problematic, at least in the short term. For example, unemployment numbers in the US are still not great. There still are a lot of people that are unemployed, but also retail growth has slowed. So the growth in retail sales had slowed significantly, which kind of makes sense if you think about it, and is something that I think the market was anticipating, but the collection of all this information hitting the markets in a very short amount of time really scared the markets. So the Fed, in effect, said, listen, we think GDP growth is going to be larger than we thought previously, actually. And we acknowledge that inflation has increased and might be higher than we had thought it would get to, and might be more sustained than we thought. And so we are now confirming our plans to perform 2 rate increases before the end of 2023. So this happened on Wednesday. They also, the Jerome Powell, the US Fed chair, said that they were talking about tapering quantitative easing within the US. The markets really didn't like this initially. There was a massive sell-off, and then there was a rebound, and then another sell-off. But ultimately, on Thursday, as the market started digesting this information, they felt as though a rotation from value and all the stocks that have been in favor for the past few months back into tech was the play. And then on Friday, we saw someone from the Fed, Fim Bullard, say he thinks that first hike out of those 2 hikes might happen as soon as 2022. And so he said this on Friday, I believe, and then there was a sharp sell-off across just about everything in the stock markets and commodities on Friday. So a very, very red day across just about everything. This meant that the dollar got a lot stronger, because the dollar is a safe haven. So this is a daily chart. So the dollar strengthened quite nicely. And when the dollar strengthens, that means that things that are priced in dollars often sell off quite sharply. So you can see that the commodities were selling off, to be fair, ahead of this announcement. So especially the likes of, if I open up lumber, were selling off, but the strengthening of the dollar means that a lot of these things also sold off a bit more. So lumber is quite an interesting chart. If you look at the daily chart, you can see lumber rose. It led the commodity rally massively, and then we see this enormous sell-off over the past month now. So lots of interesting things happening. Let me summarize them and give you a bit of my perspective. Commodities have been rallying for the past year. Lumber kind of led that rally, although there were other commodities that were also increasing quite rapidly. These commodities are used to build just about everything. When you include copper, iron ore, lumber, etc. into the picture, almost everything in the world is made from these materials and commodities. So a price increase in those commodities means that the price is either absorbed by the producers or it is passed along to the consumer. And so we see prices increasing, which is effectively the definition of inflation. So this was happening as a result of unexpected surge in demand and inability to meet that demand because of a lack of supply, but also a few other things. So because the price was increasing, there were people that were hoarding more than they needed of these commodities, which drives the price up too. And then because the prices were increasing so rapidly, speculators and investors were buying into these assets, which also contributed to the price increases. But then as the supply chains started sorting themselves out, this hasn't happened in all supply chains, by the way, but as supply chains started sorting themselves out, as demand decreased, because if something is too expensive, so if I'm a house builder and I need lumber to build a house, there's only so much that I can sell a house for, and if my materials become too expensive, then I'm just going to stop selling houses. So demand started slowing, the market started getting scared, the people that were hoarding and speculating stopped buying things for these reasons, and also because China was trying to rein in the price of certain commodities. And this means that a little bit of this demand, this price increase has unwound. And so we've seen this dramatic drop in lumber. We've also seen it in other places, copper, for example. And so those prices are cooling down. We've also seen that in retail, the growth in retail sales has slowed down. And so there are a few areas of the market that were looking very, very hot that are starting to cool off now. And in my opinion, these, I don't know for certain, but these things are starting to point to the fact that the Fed was right, that inflation will settle at a higher level than it has been for a while, but that these big spikes that we've seen in inflation will probably work themselves out once the supply chains have resolved their challenges. Okay, so what I also wanted to look at is we're seeing just in terms of quantifying that rotation that I mentioned earlier. So we can see these are the US sectors and the US industries, and I've sorted this by the month to date returns. So over the past month, we can very easily see these prices are lower than they would have been if we didn't have that major sell-off last week. But still the pattern was already there before June 16th, right? So everything took a tumble late last week, but the pattern was already there before that tumble. And so we can see that inflation plays and value plays were being unwound, and that money was starting to move into more of the growth sectors, once again, as you can see over here. Now, that's not to say that we're going to see a mega growth rally like we did through last year, but I think that money favored growth stocks last year. Some of that money has now sloshed around and moved into other sectors. So now the entire market has been lifted and is a bit higher, and now we're going to see capital inflows into technology stocks again as people look for the kinds of returns that you get in growth stocks. So the market, I think, is healthier for what has happened over the past few months, and we will see if this return to technology is sustained. I also wanted to briefly talk about bonds and bond yields. So bonds are quite interesting because they are the largest market in the world. They are traded mostly by financial institutions, big companies, as well as governments. And so they can confirm or refute what is happening in the equities market. So they're a good point to refer to if you want to confirm a trend that you're seeing, or see if equities are reacting silly or not. So on when the announcement was made last Wednesday, we can see that we've got the 30-year yield, the 10-year yield, and the 2-year yield on these different bonds of different durations. And just a quick primer. So bonds with that longer durations, so the further out they are, the more they are affected by changes to interest rates. So longest, middle, shortest duration bonds right there. And the relationship between bond yield and bond prices are inverse. So these are the yields. So the prices have increased and the yields have dropped on the longer term bonds. And so people were rushing to them to buy more of them because they will make more money from them in the long term. Whereas money has left the shorter yield bonds in favor of these bonds. So, I mean, there's nothing unusual about this. This is just confirming more or less what we've seen in the rest of the market. And just to keep perspective a little bit, although this is a forecast, by the way, so obviously with the forecast, nothing is certain, but this is the way that the US Fed is seeing things playing out. Maybe the inflation number is going higher than they thought, but effectively the blue line is where we've been or are, and the gray line is the forecast. So the expectation is that we are now approaching the local top of inflation, the inflation rate, and that we will, after that, once the supply chains are sorted and the world is back to normal, if that happens, then the rate of inflation should drop off until we're more or less in the same kind of range that we have been for the past decade that we can see in this picture. So this is the expectation. We will see if it happens, but so far from my analysis of historical events, so global economic recoveries after world wars and other pandemics, what we're seeing here isn't unusual. Our current situation is unique because of our technology and the connectedness of the world today, but otherwise the world is the world, and these patterns should play out in a similar way. Okay, let me speed it up. I've been going for a long time. So last week we saw quite a large sell-off in semiconductors. I wanted to focus on the sector. It is one of my favorite sectors, and I think that it's the one that will see some of the largest growth through the next few years. So since the beginning of the year, this ETF, this is a semiconductor ETF, and you can see that semiconductor prices have been trading in a range, which is to be expected because from the bottoms of the crash last year, we saw a monumental rise. And after any monumental rise, we'll see either a big correction downwards or we will see a sideways consolidation for some time. So a lot of semiconductor companies are doing very well as businesses. Their margins are improving, their revenue is increasing. There's a massive chip shortage globally. There's a much bigger and what I think permanent demand for semiconductors as the world has moved more online than it was pre-pandemic. So a lot of people were forced online, and I think that that is here to stay. We've kind of jump-started the move to everyone working online by virtue of the pandemic happening. So semiconductors do generally tend to be a little bit more volatile. They have higher beta than the rest of the market. So a sell-off in the market usually is a bit more exaggerated in semiconductors, and then a rally is more exaggerated in semiconductors. But we also had a few negative articles about Micron. So this one is it talks about negative comments, but actually this business's price target is still more than 20% up from current levels for Micron. Micron is one of my favorite stocks at the moment. Similarly, we saw another article talking about selling prices being soft, particularly in Micron's wheelhouse for the second half of the year. And my research, I don't think that this is true. If anything, I think at very least Micron's is going to be flat on the year, but far more likely that their revenue and their profitability are going to grow through this year and probably next year too. So it might be that semiconductors were pulled down by Micron, but also just there was a big market sell-off anyway. On top of this, we also had the triple witching of June. So triple witching it happens on a day 4 times a year when stock market index futures, options, and stock options all expire on the same day. Now, this doesn't always create volatility within the market. It usually does increase volumes, and the fact that we had a bit of a trigger and there was a sell-off anyway might have meant that the triple witching on Friday contributed to the strength of the sell-off that we saw. Maybe. What about this week? So the Fed will be talking some more this week, various people from the US Fed, and so investors will be listening out to see if they give any more details around monetary policy. I think people are particularly interested in the details of tapering, quantitative easing, but we'll see whether those details emerge. I'm not so sure. We are also getting close to some earnings. So Micron will report not this week. This is next week. I'll be very interested in what happens in this earnings report. And then a week or so after that, we see the rest of the gang getting in on the earnings report action. Just bear in mind that the institutional investors buy these things usually way in advance of the retail investors, expecting retail investors to start buying them close to the report dates. So if you find anything attractive now, you probably should have bought it already. Okay, and the second half of the year is the best half of the year for retail businesses. I'm talking about this because the China's shopping festival I think it's just ended, and the numbers have been very, very, very strong. So this is a fairly long shopping festival in China. Financial houses will start looking towards the end of the year and thinking about who benefits most from the retail season. So in the US, there's Black Friday, Cyber Monday, Christmas, obviously, Boxing Day, etc. And so companies like Amazon, Alibaba, etc., as well as the payment processing companies like Square might do very well out of that season. You need to be careful who you pick. So, for example, Apple usually does very well in the second half of the year. Although I'm still not sure whether I would pick up Apple at current prices. I think there are better players. So, something to think about. One part of making money in the stock market is making sure that you're planning ahead of time and you're ahead of the rest of the market. But you also need to be picking the right companies when you do so. All right, that's it for this week. Sorry that I didn't do a video last week. It's been a very hectic 6 weeks for me, but I'm back and I'll be making videos and other content regularly. Have a great week and I'll speak to you soon. Bye.